Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Howard Chan. He is from Kurv Investment Management, and we are talking about their Technology Titans Select ETF, which is ticker KQQQ, which is a really interesting and cool product. I love the way that it operates as an active ETF. It is looking for really direct technology exposure in a handful of select names, and then it will weight based on positive momentum signals. And when you have some waning momentum, it is going to write some covered calls on those names for income. So a two-way product here focused on growth as well as risk management. So I think you'll find the construction of this product and also the overall discussion very interesting. So please enjoy this episode with Mr. Howard Chan. Hey, Howard, welcome to the show.
Glad to be here.
So before we get started, why don't you give everybody a bit about your background and how you eventually decided to start Kurv?
Yes, my name is Howard Chan. I'm the founder of Kurv Investment Management. To be honest, I ended up in finance through a string of lucky things that happened in my life. I was trained actually as an engineer. I was an electrical engineer in computer science. As I was going through that internships, I realized that might be the wrong thing for me because I was just sitting in front of a computer all day with no human interaction. And so I try to broaden that out a little bit by being more of a consultant in technical fields, which had more interactions, but also got a little bit bored, to be honest. And so I had this moment where, well, what am I going to do next? And I think a lot of engineers, when they're at engineering school, they don't think about finance because it's not as rigorous as, say, building a bridge, right? You need to know how many cars you can go across the bridge. But I was wrong. I think it's because the system is so complex that you can't capture everything. And so I kind of fell into it. And it's been extremely fascinating, constant changes, things to discover and learn. And yeah, it's been a great career.
So when you're not working at Kurv, I always like to ask people before we get into the nitty gritty, any hobbies? What do you like to do for fun?
Yeah, I'm actually really into music. And if there was an alternate reality, I almost became a conductor, actually. So I play the piano and the violin. And so whenever I have kind of friends around that wants to jam or, play something, that would be, I'm a little bit more rusty now, but that's always something that I would love to do, just to get, mind out off of work and just do something a little bit different.
Yeah, I'm envious of that. I've always wanted to learn how to play the piano, but for some reason, my brain just was not able to figure out how to read music. I just couldn't do it. So let's talk about Kurv as a whole. You guys do kind of a variety of different things. So how does the business help clients? How are you serving clients as the landscape is set today?
Yeah, the mission for Kurv is that we want to make well-designed, tax-efficient, institutional-grade strategies available to all investors. And maybe a little bit of a background. I had previously worked at Goldman and Pimco, and I led their ETF business actually in Europe. I had actually taken a break. When I came back to the US, I met a lot of advisors just, at random events, and they were talking about how they had, investment problems to solve in their portfolios. And given, my background, what do I do about them? And we try to find solutions. And it was kind of when I realized that, a lot of obviously at Pimco and Goldman, you work with a lot of really large institutional clients. And you realize there's a lot of best practices that are not really available or accessible to all investors. And so I actually went back and I talked to a lot of folks who also left Pimco, but who I worked with the ETF business. And I said, hey, there might be an opportunity to make things accessible and available. Are you interested? And a lot of people were actually very interested. So we got 80% of the folks at Pimco are all folks that I've worked with. And we kind of brought the band back together using a music analogy. And so that's really what we're focused on. I want to kind of deep dive into two aspects. So, the tax efficiency is actually very important to us because there are actually a lot of really great institutional strategies that are incredibly tax inefficient. They trade a lot, but that's okay because the people who are using it are non-taxable entities, pension funds, endowments. So they don't really care about taxes. But as soon as you move down to taxable entities, those strategies don't work as well because you have this layer of tax. So our idea was, obviously, maybe a lot of your audience, are familiar with tax loss harvesting. That always philosophically didn't quite make sense to me because you have to have loss first, right? So what we wanted to do is build a strategy that thinks about tax on the gains. And so that's kind of built into each one of our strategies. And I can go into detail when we talk about the various things that we have. And the second part is institutional grade. So your audience probably are aware that a couple of years, 2022, I think, there was a change in the ETF rules that allowed derivatives. And what that actually opens up is accessible to the different kind of risk premia that all investors were not able to access unless you were the largest investors, right? And primarily using derivatives, there's, you have to set up ISDAs, you have documentation, collateral management. Those really were not available to all investors. So what we want to do is just to make that easy. And there's risk premias that, for instance, volatility risk premia that are much easier to gain access to. You can get it in other asset classes like mortgages or whatnot, but or assets that have optionality in it. But now you can have a direct access, and these are actually some risk premias that even at my former employers that these are the consistent risk premia that they tap into to outperform their benchmark. So we want to kind of build in these strategies now so that it's available to all investors.
Well, let's talk about that a little bit. And you have you have a handful of ETFs, and the first kind of tranche of ETFs that you launched were, your single stock yield premium strategies. So can you talk about how those products kind of operate underneath the hood and really what they're trying to accomplish for an investor?
Yeah. So we always, maybe this is back to my engineering background. It's like we always start with a problem and we try to find a solution. So here are two issues that we were trying to solve for. The first is that generally, if you look at the 6 ETFs, the yield premium cover call ETFs, they're generally technology names. And there's actually a characteristics about tech names, which is that they generally do not distribute dividends, or if they do, they're very low dividends. And so if you were an income-focused or dividend-focused investor, and you want that income, generally you have to overweight a few common sectors. They're financials, utilities, and energies, right? And you're underweight tech to get that dividend yield. And if you think about that, you're actually overweighting older parts of the economy, right? It used to be energy is the largest part of the Dow. Financial also was a big component. Those are much smaller now. And then you're underweight the growth part of the economy, right? So we kind of started these single names as a means for people to make that trade-off a little bit easier. So if they buy a basket of those names, they can actually generate income on a growthy part of the economy. They could still hold the other dividend stocks in the other sectors, but now it's more balanced to what an S&P would probably look like. And the other problem that we were trying to solve was actually These cover call strategies are not like new, right? They've been used since the 80s for really large private wealth advisors to generate some additional income in folks' portfolio. And the flow would usually be, maybe it's client driven. Hey, advisor, can you look through my portfolio, write some cover calls? And then the advisor would go through, 30, maybe 40 line items, see what makes sense. They might not know how to trade options. If you're really at a really big advisory firm, maybe, you might have a dedicated execution desk so you can execute options. But if you're a smaller advisors, those are not necessarily even available. So the idea was for these particular names that you can now, even if you're a smaller advisors, self-directed investors who are focused on income, you can access these strategies immediately. But more importantly, I think most people don't talk about is when you want to exit the strategy, you have to unwind these trades, right? You have to buy your cover call back, and so now instead of making those kind of unwinding, you can just sell a share of the ETF. So that was the problem we were trying to solve with those funds. And generally, those funds are intended to, and we've seen the investor set is generally people who are close to retirement, who are retired, who want to supplement some of the income. And we try to keep the distribution as stable as possible so they can kind of predict what portion of supplement of income they want to have in their portfolios.
So for kind of the audience of the show who's maybe a small to mid-size RIA, or people that are in the ETF space, when you're writing a covered call on a single name here, like what, if any, upside are you giving up in the growth potential of that security rather than owning it outright? I know we're getting the cash flow, but are you giving up any upside?
You are. And the way I would think about cover calls, cover calls work really well in three different environments, right? When the underlying is falling, when the underlying is trading sideways, or it's slowly appreciating. And for those who don't know what a cover call is, you have an underlying asset. Let's say I have a Tesla stock, and then I'm writing in sort of out of the money. So let's say Tesla is at 100. You're writing a call that's maybe a little bit higher at 115. You receive a premium. That's the income that you get. And as long as the underlying stock doesn't go above 115, you get the full amount of premium, right? So you are trading of some potential upside to getting that income. And that is actually, this is why the original 6 is very more suitable for folks who are in retirement, where the price appreciation potential is not as important as steadiness of income. I will say, a cover call is not great in an environment where you have sudden sharp increases in price appreciation, because you're capping up the stock's appreciation, right? So the big question always is like, would you have wanted to write a cover call on NVIDIA this year, right? It almost would be better for you to ride the price appreciation and sell some shares to generate the amount of income, right? So I'm generally pretty forward about, the cover call strategy is very, good for a specific set of investors that want to have the income. They don't, we think about total return as having three components, right? There's the price return, there's the income return, and there's an FX return. We're generally buying US assets, so that's zero. So it's really price versus income. And this set of investors is really focused on the income that's being generated and less so on the price return. So, yeah.
And speaking in generalities, I don't want to hold it to a specific number. Generally speaking, what are kind of the range of distribution yields on these single stock strategies?
Yeah, so we on our ETFs, it ranges from the less volatile names like Apple. They generate 10 to 12% of distribution, to more volatile names like Tesla. They generate up to 30%. And so, and it's worth mentioning, why would you do single stock maybe versus an index, right? So, after 2022, we saw the slew of cover call ETFs coming out in the market, and largely because the economy at the time was not doing very well. So it was a great environment to clip coupons while the kind of the economy gets sorted. But there's actually been a kind of an interesting thing that's been happening in the market up until the recent kind of tech correction, which is that, volatility was at almost 4 years low. So when you're writing a cover call, essentially what you're doing is harvesting this volatility premium, right? And inherently it's low because in an index, there's diversification in that index. So the volatility, the pricing of volatility would be lower. But on single names, the volatility is actually quite high. So what you can do in some ways is to buy a basket of single names. You get the risk premium first, and then you get the diversification later with the different combinations of single names. So that's been kind of written about in sort of this divergence of single vol versus index vol that's in the market.
Well, we're here today to talk about your newest issue, which is KQQQ, or KQs as I've been calling it, which is your Technology Titan Select ETF. So first, at a high level, a simple question, what is this strategy trying to accomplish? And then I have some more detailed questions behind it.
Yeah. So the strategy is looking to provide a strategic exposure, so something you would hold for 3 to 5 years, of the largest technology companies that it has basically asymmetric upside and downside. And it looks to essentially provide income when market is correcting to mitigate any downside volatility. And then when the market is going up, we want to be able to magnify the trends in the market.
So let's talk about first, like we're going to get very targeted in security selection here, but what is it about broad technology exposure rather than the targeted exposure that you're delivering? Like, what is it about that can be a benefit to somebody who wants to invest in the tech sector?
Yeah. So this is actually very, when you launch an ETF, you have to file it 75 days before you launch, right? So we were already kind of anticipating at the beginning of the year that the pricing of technology companies is becoming rich, and that how do you maybe I should go kind of go back a little bit, which is we see this as a strategic exposure, so something that you want to hold for the next 3 to 5 years. And the premise is that a lot of these technology companies do have extreme pricing power, and they're very dominant in their vertical, whatever that is. And the way we describe technology is not just software companies or semiconductor companies. It's any companies that have used technology to essentially leap forward in their vertical. So that includes also, Netflix, which, changed the way that we deliver media, right? And so we went back. There's been a lot written this year about, how the market is driven by 7 names and what's happening with the rest of 493. We actually did research going back 20 years and see actually if this cohort of larger names actually behave differently. And what we've seen is that year over year, even in the last 5-6 years, these names have outperformed the overall benchmark. So if you just use a proxy like the top 15 names on Nasdaq versus the Nasdaq 100, which is the broad benchmark, year over year, it's actually outperformed 400 basis points about. And that's really unusual because if you think about it, the larger the company is, the growth trajectory should be slower, right? Because they're a larger part of the market, and it just doesn't quite fit technology companies. And so what we wanted to do is, and by the way, the portfolio is generally a basket of 15 to 20 names. So it's not just, the largest names in the basket. And so, so one of the things that we wanted to focus on was the sector is attractive, but we do accept that if you accept that this is a strategic exposure that you want to have your portfolio, then what is the behavior of this basket? And in technology, we know there tends to be exuberance and then correction, right? That is a behavior of the sector. Like the most recent one, I would say, is during COVID. Everybody thought we would never, ever go out of our homes. So, there was a huge price action. And then as soon as COVID went away a little bit, there was a correction, right? So if you accept that this is a strategic exposure and this is the behavior, then the question is, how do you take advantage when it's during the exuberance phase, and how do you minimize the correction? That's our premise. We don't want to guess whether it's rich or we know it's going to happen. So when it happens, how do you deal with that? Because I think that one of the things that a lot of asset managers really talk about is their view on something, but they never talk about, but what if they're wrong? What hedges do they put in your portfolio? Right? They never mentioned that. So we accept that, hey, our view is long-term, this is going to be great, but we know there's short-term volatility. So what sort of hedges do we put in our portfolio to mitigate when we're wrong? And then the last, again, we try to solve for problems for the strategy. So the three things that we were trying to solve for is income on technology sector. We've discussed that. Two, how do we deal with this boom and bust cycle in technology? And the third one is actually weaknesses of the covered call strategy. So you brought up great point, right? Are you trading off some upside, right? Would you want to write a cover call on Nvidia? How do you deal with that? So we built the strategy to address those three things. Yeah.
Yeah, and I definitely want to get into how you do that in terms of implementation. So let's drive down into the underlying strategy. So 15 to 20 names. What type of kind of filtering or factor process you're going through to get to your initial 15 or 20?
Yeah. So the first step of the portfolio construction process is what we call smart security selection. So one of the things that I think oftentimes when people have technology exposure, like things like the triple Qs or whatnot, they buy Nasdaq and they assume that's the technology allocation. But that's actually 20% of that index. That merely means the names that are listed on the Nasdaq index exchange. It doesn't mean they're technology. So 20% of that index is actually not technology. So what we do is we actually are agnostic in terms of the exchange. We look at the whole entire set of technology names. And we actually, more importantly, remove the names that are not technology. So for instance, I'm using the top 15 names on Nasdaq just as an example. Pepsi, Comcast, and Linda, which is a German gas company, is actually, Costco is like a huge component of the Qs. And actually, if you just remove those because they don't have that growth behavior, it already improves actually the performance of the basket. And then additionally, if you look at other exchanges, for example, Oracle is listed on the New York Stock Exchange. There's other names like ASML that's not US. You can buy those. We can buy those. We don't have it in a portfolio right now. Hedge out the euro risk. Then you have a more complete picture of what that basket would look like. So that is the first step in terms of looking at what is the core 15 to 20. And another thing is that, part of why we're not quite concerned about this Mag 7 raise up is that there's other names that have underperformed in the basket that if there's a mean reverting component to it, we think the other, potential 18 names or whatnot can actually also be performance drivers in the basket.
So here's where I think your engineering brain is going to come out. It says, when I was reading the prospectus, you're weighting these dynamically in an optimized way using momentum signals. So can you talk about the process of, rebalancing the portfolio and maybe dive a little bit deeper in, are you looking at kind of shorter term momentum, cycle momentum? Can you talk about, I'm sure, your underlying process that you guys probably had some hands in engineering and trying to derive what momentum looks like?
Yeah. So again, we kind of accept the behavior of the sector that we are in, and we design a strategy around it. And so, a lot of technology companies are growth stocks, and growth stocks tend to exhibit momentum, right? And so what our strategy does is that when there is upward momentum, we start overweighting basically the names that have upward momentum. And we start, what we've seen is that if you take a look at, for example, the top 15 names, that the cycle of average of tech, the names that have upwards price momentum for tech names is actually an average about 10 months versus non-tech is about 7 months. So what we want to do is obviously get at the beginning of that cycle, right? So we on our momentum signal, what we do is there are some shorter term signals. So when we start seeing those kind of behaviors, we start overweighting by about 2.5%. And when they're in the middle of that cycle, we'll overweight another 2.5%. So the overweight is actually fairly modest. The maximum is about 5%. But we want to capture some of the overweighting at the beginning of the cycle. And if the momentum tend to be true, then we overweight it more in the basket. Now, yes.
I was going to say, how often is that kind of signal reviewed and that overweighting occurring? Like, do you have it on a weekly or monthly cadence, or are you basically looking at them on a day-to-day basis and realigning the portfolio as necessary?
Yeah, so one consideration of the design is also to have not too much turnover transaction cost. So first of all, I forgot to mention in the 15-20 names, we actually rebalance quarterly because we don't want short-term volatility to incur costs. One of the things you might not be able to manage the market, but the one thing you can manage is the cost in the fund, right? So we want to minimize that. In terms of the momentum weighting, we take a longer view. And when I mean that is, if this is an exposure that is going to be in your portfolio for 3 to 5 years, the shorter signal would be on a monthly basis, not on a daily basis. We think daily, there's too much noise in there. Signal to noise ratio is very, very high. And then we have a longer term that says, okay, if the average momentum cycle is 10 months, we can maybe cut that in half and get the second wind on those particular names. Now, this actually brings up to the third part, which is what if a name doesn't have momentum? What happens, right? And then in fact, I would argue when a name doesn't have momentum, upward price momentum is actually perfect time for cover calls. So remember in the environment that I mentioned, cover calls great when it's trading sideways or it's going down, right? So that when there is no momentum, signals switches on. So we start writing cover calls on those names that have negative price momentum. And that actually helps us essentially making sure that all of the cover calls expire out of the money. And we can clip those coupons, get those premiums in the portfolio. And that's part of income generation in the fund. It's sort of dynamic. And one of the special behavior of this design is that, let's say we have a market sell-off that we've had recently, right? So many of the names don't have price momentum. So everything starts turning on the cover call. So you generate more income. And that's sort of the counter-cyclical income generation that will cushion your downside. And then on top of that is that when there is a sell-off, implied volatility tends to go up. So the amount of premium you get would actually also be incrementally higher. So that's how we think about, and maybe I should tell you a little bit of the origin story about this. So, we launched the 6 cover call ETFs because we want them to be tools. People can pick which names they want. And the most common questions we get was like, we don't want to make a decision. We want you're the manager. We want you to make a decision. So we could have kind of just did a basket of the 6 ETFs, but we actually went back to the drawing board and said, what is a strategy we want in our portfolio, right? We know the weaknesses of cover call strategies. We want the upside, but we also want the income. So that's how we came to this dynamic weighting to, again, asymmetrically get the upside and then cushion the downside for the strategy.
Well, I think the strategy is, this is episode 54. It's one of the most unique ones that I've had the ability to kind of dive into. So, if you're an investment advisor, you're sitting there, you've got an existing diversified model portfolio, and this comes across your desk, which is kind of a tech focused ETF that gives you the ability to get upside, but also is going to flip and write covered calls when there's waning momentum. Where are you putting this? Like, how are you advising your clients or investment advisors of where to kind of slot this in an overall asset allocation?
Yeah, that's also part of the design, right? So when I was at Goldman, I was actually the asset allocator for huge funds to make decisions about asset allocation. So let's start with essentially a 60-40 portfolio, right? This would fit into obviously the large cap bucket, large cap growth. We think it'd be good substitute for just a triple Q allocation. Part of the reason why maybe we named it KQQQ, just for the downside mitigation, right? It would be a complement to an S&P exposure because S&P already has overweight some of these tech names, so this would be used as a complement. The other thing in terms of asset allocation we thought about is actually the switching cost. So, in the market right now, there's a lot of discussion about, people are rotating into small cap. I think that story's kind of faded away. But, if you're an asset allocator, there's an issue with that statement, which is a unit of risk of large cap is not a unit of risk in small cap. Small cap is much more volatile. So in an asset allocation, that's always a smaller part of your portfolio, right? So you can't just allocate yourself out of large cap. So that's why we decided the downside mitigation is actually more important because you have this core holding you have to hold for your risk exposure. And maybe just why do we think about using income as downside mitigation instead of buying like protection, right? I personally have never really seen a tail risk hedging strategy that works. And the reason is because when you buy tail risk, it's like insurance you want to buy. It's hard to gauge the size of the down, how much premium you want to pay to insure your downside and how do you size the downside cap that you bottom that you want to cap down, right? And if you don't sell this premium and you want to buy a put when the market sells off, the put is already very expensive, right? So and then you're using capital to buy the put. So our thinking is instead of spending capital, you generate capital to mitigate the downside. And so going back to the asset allocation question is that also we know many people have held technology names for a long time, right? They've probably written before COVID. So if you were to really, you can tactically modify on the edges, but if you were to really sell out, you're going to get a huge capital gains tax, whether it's long term or short term. The tax bill is going to be there. So if you want, you want to minimize that tax efficiency also, right? That's part of what we think about is the taxes. Is you hold this exposure, you generate income, so you don't have to sell out of that exposure and have a tax bill essentially when you reallocate, and you hold it. And that income might give you some ordinary income or some whatever, but that's excess capital you wouldn't have ever otherwise have. So that was our thinking in terms of this design in the asset allocation perspective, where it fits into the portfolio.
Well, Howard, this has been great. I really appreciate your time with me today. Before I let you go, where can people learn more about you and get all the information on all of your ETFs?
Sure. Our website is www.kurvinvest, KURVINVEST.com. And all of the information will be on that website. Probably don't need to find me. I'm less interesting than the website that we have. So I will be on there too. But that's where you can find all the information.
Well, again, Howard, thank you so much for being with us.
Okay, great. Thank you.